Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, I'm Vinay Joseph and welcome to another edition of our podcast, What is Driving the Market, where we look at key market events, key investment themes, and address key questions on investors' minds. It has been a volatile start for Indian equities in 2022. Sentiment has taken a hit given the looming risk of faster rate hikes by the US Federal Reserve and possible policy normalization by the RBI, which has driven bond yields higher. Further, aggressive foreign investor selling has exacerbated the fall. With numerous headwinds, why do we expect equities still to continue to do well? On a medium and long-term time horizon, we believe the case for Indian equities remains strong, driven by four factors. First, a pro-growth budget with a significant increase in spending, especially towards capital expenditure, is likely to strengthen the economic recovery. We expect economic growth to remain well above its long-term trend, with the likelihood of further upgrades to consensus GDP growth for fiscal year ending FY 2023. Second, above-trend economic growth is likely to support earnings expectations, the main driver of equity returns in mid-cycle, which remains robust. Consensus expects Nifty index earnings to grow 37% and 19% for FY 2022 and FY 2023 respectively. Both are ahead of major markets, and there is a likelihood that we continue to see EPS upgrades. This is quite similar to past market cycles, where multiple expansion drives early cycle returns, while earnings growth helps sustain the equity returns in mid-cycle. The third factor is, historically the start of hiking cycle has not stood in the way of equity market outperformance, as a hiking cycle usually starts because the economy is doing well. Equity markets tend to underperform when policy reaches an outright tight level, and we believe the economy and markets is far away from that point. Fourth, aggressive selling by foreign investor and Indian equities underperformance compared to peer over the last 3 months has moderated stretch valuation and elevated investor positioning, which indicates that investor exuberance, which was a little too high towards the end of the year, has started waning. So we would continue to use market pullbacks as opportunities to add exposure to equities. Within equities, we maintain our preference for large cap equities given better fundamentals and greater valuation comfort, and our value style equities tilt given a reflationary macro environment, favorable valuations, and better earnings. That's it. If you want to know more about our market views, please reach out to your relationship manager. And if you like this podcast, please don't forget to subscribe. Thank you.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered relationship manager or visit www.se.com/in.